Welcome, everyone. I'm Allison LaForgia, the managing editor of the content studio at HousingWire. And before we jump into today's webinar, the $29 trillion opportunity, smarter strategies for HELOC growth presented by Experian, we have a few housekeeping items. So today's webinar is meant to be interactive. You can submit questions at any time to today's experts by using the Q&A icon at the bottom of your screen. I'll be keeping an eye on the Q&A throughout the actual webinar. Time permitting, we'll answer as many questions as we have time for at the end of today's webinar. Now, I want to take some time to introduce our panel today. I am joined by Upavan Gupta, Ivan Ahmed, and Devin Smith. Let me introduce all of them a little bit in more detail so we understand the experts who are joining us today. Upavan is the head of data and analytics at Experian and brings over 15 years of deep industry experience to his role as the research and analytics leader for Experian's housing and verification businesses. He oversees the development of innovative AI and ML-driven models, products, and actionable insights. Leveraging Experian's extensive data assets, Upavan's team pioneers groundbreaking thought leadership in the industry. Additionally, he guides the generative AI initiative within Experian Housing, shaping the organization's strategic endeavors. Thank you for joining us, Upavan.
Thank you.
We are also joined by Ivan Ahmed, who is the Senior Director of Product Management at Experian. Ivan leads the mortgage prospecting suite within the housing business. He played a key role in bringing Experian's property data asset to market and continues to drive innovation across marketing and acquisition solutions. Prior to Experian, Ivan co-founded a fintech company in 2015, which was later acquired by a major bank. He brings deep experience in both front-end and back-end software solutions for banks and mortgage institutions. Thank you for joining us, Ivan.
Thanks for having me.
And we are also joined by Devin Smith, who has spent over a decade in the fraud and analytics space and is currently the Director of Solutions Engineering at Experian. He's a subject matter expert in third-party fraud prevention, specifically the application of behavior, device, and network technologies to combat fraud rings. Now, with that, I'm going to turn things over to Upavan to talk to us about why today's webinar matters more than ever. Upavan, the floor is yours.
Thank you. We're gonna start looking at what this 29.5 trillion opportunity means, really, in terms of HELOC as a product, how it has grown over the years from a back pocket safety net type of product to a much more actively leveraged financial instrument. Right. But before we jump into that, what we need to understand is how we got to this big number, right? How we got here. So if you go to the next slide, what we saw. Should we start with the poll question first and then jump onto the actual slide? Yeah, let's do that.
Let's start with the poll question. So to our audience, how are you currently marketing, or are you currently marketing HELOCs? So you will see the poll question pop up on your screen and let us know, yes, are you actively marketing HELOCs and see strong borrower engagement? Yes, market HELOCs, but results have been mixed. Or no, we offer HELOCs but aren't currently marketing them. Or are you not marketing them and at this time at all? So let us know where you're at. Okay, I see a lot of movement in A and B. Let's see where this lands. Let us know where are you at with marketing HELOCs? Okay. I still see some responses coming in. Everyone check out the poll question. Let us know where we're starting, and we'll give a little bit more context to you, the largest segment specifically, as we go throughout today's conversation. Okay. So I am going to end the poll here and I'm going to share our results. So I see a lot of A and B responses. Does that surprise y'all?
No, not at all. It's a very it's a very active conversation. And Ivan and I, we look at it every day. We have engagement with our partners, and this is always a question that's I mean, that mixed results is always a key point of conversation, right? So, and that's where a lot of the enhancements and how things are changing, both in terms of the consumer and in the marketing aspect of HELOCs, that has evolved. So it's absolutely what we see on our side.
So let's move on to going back to that landscape.
Cool. Yeah. So, yeah, I mean, we started with that 29.5 trillion opportunity, right? How did that come to happen, right? It started back in 2020. So between 2020 and 2022, there was a historically low interest rate period, and the rates dipped below 3%. It caused a boom in both purchase and refinance activity. And a lot of homeowners, millions of homeowners, they were locked into ultra low rate environment. Then inflation ticked up, and early to 2022, everything changed, right? We very quickly went to a very high interest rate point, but it was a little bit different because it was a rare combination of high rate but also high prices, home prices. So which as a result, as everybody noticed, that dropped the whole purchase and the refinance activity, right? Everybody's expectation was the interest rates would go down a little bit quicker than what ultimately happened, or the home prices would stabilize or maybe go a little bit lower. It didn't happen. The home prices are still on the upward trajectory, not at the same rate, but still it's growing. There are micro markets within US that have seen a little bit of a dip versus some that are continuing to grow. But as a result of this 4 or 5 year period, in fact, like a 3 year period where there was a high amount of equity that was built in these 3 to 4 years, but interest rates being so high, a lot of homeowners had built equity, but they were locked into a low interest rate and they can't do any other activity, right? So, so that's why one of the recent surveys, it says that about 61% of homeowners, they don't plan to move for the next decade because they don't see enough equity or enough opportunity to actually benefit from this whole macro environment. And the other aspect is the affordability is continuing to become worse. The monthly payment right now for a mortgage is nearly double than that of 2021. So it's making it very financially unattractive for most home buyers, homeowners, and it's opening up a very unique opportunity for consumers to leverage the equity that they have built into their home, and use that for liquidity, right? So that's how we have got here, and it doesn't look like it's a short-term behavior. It's going to be higher for longer type environment, which makes it one of the central parts, the HELOC especially, as one of the central parts for banks and consumers for years to come. So that's how we got here. Now, I think the next thing that we should look at is who are these consumers, right? What do they need this equity for? Just looking a little bit deeper into the data itself. What you see here on the graph is about 95 million Americans own residential property, out of which there is a huge segment, which is that 29.2 million consumers, about 30%, they meet three key criterias. So they have a very strong equity position, that's more than 20%. That checks the HELOC box right away. A lot of them have a lot more equity because, especially the ones who had purchased the homes before 2021, in fact, right? And then they don't have an existing secondary lien. They can tap into the home equity. They haven't done it yet. And the third one is they have a first mortgage in place. So in most cases, it's already a low interest rate mortgage that is not going to be refinanced anytime soon unless the rates go sub 5%. So they are unlikely to refinance, but they still need capital, right? So that's one of the big segments that is out there for equity. The second one is actually the ones who already own the property. They don't have any mortgage on the property. So there are about 35 million homeowners that fall into that particular category. And they continue to see a persistent increase in the debt. It's both inflation, but also a lot of other factors like insurance. Insurance in certain states, home insurance particularly in certain states, has grown to, I think, by 50% since 2021 to now, which is a significant amount. Even a lot of counties have reassessed the taxes on the properties with the more recent values. So they are having they're facing pressure from cash flow perspective. Labor market, again, overall labor market is strong, but what we have seen is the type of labor market has shifted. It has become a little bit low, actually significantly low in terms of the high paid jobs. I was looking at some metrics, and between 2015 to 2019, about 38% of the job creation was from the high wage roles. In 24, it was just 12%. So there is that whole segment of consumers that are asset rich but liquidity constrained, right? So these are the consumers who are looking for home equity to extract that home equity. But I know, Ivan, you are on the forefront of the whole HELOC product management and marketing. So I would like to ask you, what do you see as the big reasons for getting a HELOC by consumers?
Yeah, so we know that there's three sort of broad categories for borrower intent, right, or loan purpose for HELOCs. So we know that generally speaking, it's either going to be for home renovation, it's going to be either for debt consolidation, or for some type of a large one-time expense, like education or medical bills. But I think what's interesting is that we're still seeing the persistence of kind of two issues around sort of consumer awareness around HELOCs. And I think one is that consumers don't know exactly how much equity they have available, right? So they have some understanding of how much their home is worth, but they haven't really pieced together how much available equity they have and how that translates to an ability to access that available equity. And then the second, I think, is, and it continues to be a persistent problem, is that there's a perception issue around HELOCs as being slow or outdated. And so I think it's not just a credit worthiness issue. I think it's both. It's also a visibility and an accessibility issue. And I think when we're looking at some of this data, what really struck me was when we were looking at the various buckets of consumers, targetable consumers for various sort of loan purposes under HELOCs. When we looked at the home renovation category, and this stat really struck out at me, we found that almost 30% of the consumers that were prime and had a property age that was greater than 15 years were actually below 43 years old. So that's very sort of counter to what most would believe would be a targetable market for a HELOC, especially for a home renovation. You would assume that the consumer would be of a higher age and would have held the property for a lot longer. So what that tells you is that there's significant opportunity for lenders to go down market and really sort of identify the various demographics that would benefit from a HELOC. And we're finding that it's not just your quote unquote traditional borrowers for mortgage products. I think with this emergence and shift to go down market, I think obviously more lenders are focusing on digital experiences. But with that shift to a digital experience, you're seeing an increase in fraud and identity issues. And so I think that shifts nicely into some of Devin's talk tracks around some of the persistent challenges he's noticing in the industry around fraud and risk.
Yeah, and as we before we jump to this next slide, I think the other thing to consider, right, that colors all of this is obviously this confluence of digitalization and the good people that we want as customers that are taking that channel. And as that channel broadens, the amount of fraudsters that go for it and the global digital access that is compounding all of this is really making it a very high value target. And that said, as we've moved to this next slide, that high value target is being targeted now by sophisticated artificial intelligence. And before you press play on this, just a quick preface. AI seems like a specter to many who don't use it. I, in my role, sit on the front lines of fraud every single day and analyze attacks and the patterns that we see. I can tell you that artificial intelligence is fundamentally changing what we are seeing and the sophistication scale of fraud. And as an example here, this is ChatGPT, and I'm asking it, if you look at the screen, to please write me a bot script designed to fill out personal information on a digital form. As you watch this, and I have no coding skills, it gives me a Python script. As you look at this script, it covers first name, last name, social security number, anything that I want, right? In less than a minute, with no coding experience, with a legal tool, mind you, I was able, and as you watch this, I'm able to create this bot script. I've recorded this for this call, of course. But notice as well, it's not just the script, it's the detailed instructions that it's providing to me. And then I go in there and I say, how can I use this to pull stolen information or pull information out of a separate spreadsheet? Got to make sure you word it right. To input it into this script. So now that I have the script, how can I leverage that with all my stolen information to use it? It tells me all these things I've never heard of, right? Download a Panda library. You need to make sure you have these requirements, Selenium or Puppeteer frameworks that help the bots walk, if you will. But the point is, without getting too far into the weeds of what you're looking at here, I have a script in hand now. Here you can see it is formatting the spreadsheet. So if I went on the dark web and purchased all this stolen information, which everyone here knows, right? Most everything's compromised. All I got to do is get that spreadsheet and politely ask ChatGPT to weaponize this for me. And again, I cannot emphasize enough that this is a legal tool. There are jailbroken versions of this. There's fraud GBT. This technology is prevalent, and the adoption of it by the fraudsters is eclipsing the adoption of AI by normal institutions, right? We're all getting used to it, but the fraudsters have figured it out faster. And so As we move to the next slide, the question one might ask themselves is, okay, that's a cool parlor trick, right? But what does it actually mean? And here, these are data points from our own data, right? We do empirical studies based on what we see on the front lines here. And here are a couple things that are worth pointing out. And I've been at NeuroID and Experian for 4 years and have watched the escalation of AI, the advent rather, and then its weaponization. And here's what you see. Last year, 30% of these attacks were automated. That's because to write a bot script on your own, you need coding experience and a few hours at least, probably a couple days to write a good script. Now, fast forward to this year, 80% of these attacks are automated and they're using AI automation. Without boring you, or well, it's not boring, it's really interesting, but you can tell I love my job. The point is when we look at these scripts and the way these bots are acting, they're much, much more sophisticated and clearly driven by AI. The second point, fraudsters use AI as an extension of themselves. So what we're seeing are these attacks that are 5, 10, 20 times bigger than they ever were, the bot attacks. But prior to those bot attacks, we are seeing human preparation where they arrive on your form or whatever it may be, they learn it, they write their script and deploy it. We can see these attacks coming now. And the last point, and why it's really pertinent here for this group, is last year we did a seasonality study of these attacks. We know July is the lowest fraud month of the year, and September is about 25% higher. Our assumption is based on just this AI trend, it's going to be well above 25% increase by September in the attacks that are coming back. Now, to the next slide, if you wouldn't mind. This is an interesting, I think, tidbit here. If you're not super familiar with bots, right, I'll personify this and kind of explain what the ecosystem looks like. Prior to AI, the bots looked like what you see there, Gen 1, Gen 2. Kind of like Terminator 1, right? Very robotic, clearly robotic. And that is what a Gen 1 script looks like. Easy to see. They type very quickly. They don't swipe. They use the same IP addresses. Very obvious to us. Gen 3 and 4 are much more like Terminator 2, to use that analogy. They're human-like. It's hard to tell the difference between them and us unless you're looking at them. And these Gen 4 bots are what make up most of the population now. And as one last nod to these bots, on this next slide here, you'll see that 12 months ago, you see on the left is a mousing pattern for an AI bot. Today, look how much smoother that's gotten. And it's not just that. What we're not showing is the fact that these bots who used to type super quickly are now typing slowly, rhythmically. They're hesitating like we are. And they're doing things to make them invisible to us. And so this is what is happening. And I can tell you every week we are seeing something new. Last week, for the first time, we saw the first agentic AI or the first AI agent attack a financial institution, which required no human intervention once it was let loose. And so with that said, I think we are on to maybe a poll question.
We are. So this question is a little bit different. So I am going to launch it for our audience now. So what we're really looking for you to do is to rank what the biggest challenges you face when promoting HELOCs before we move into our next segment. So the challenges are 1, educating borrowers, 2, the speed of approval, 3, fraud risk, 4, finding the right audience, and 5, ease of use. So you'll see on your screen, there's several button options for you to choose to rank those options. So take a moment, start with what's the most challenging option. It'll be interesting for us to see these as they come in. So the challenges that you face, and then the panel will discuss the results. Okay, I see we have some polls coming in. I'm going to give everyone a moment longer to review what that most difficult aspect is. Okay. Ooh, that nudged some of y'all to submit your responses. Okay. If you're still reviewing, I'm going to give you a few more moments and then we're going to share these results and talk through them. Now I'm going to share these results. So at the bottom of your screen, you'll see the biggest challenge is that light blue color, the second biggest challenge, which seems like there was the most agreement on. And then orange is third biggest challenge, fourth biggest challenge is that teal color. And then we have that yellow smallest challenge. So is anybody surprised by this result? It looks like finding the right audience was a pretty big problem for everyone. All right, so I know that we're going to dig in specifically to that in the next portion of our webinar. So I'm going to pull these poll results down and move on to the next section, which is specifically that audience piece.
Mm-hmm. Yes, it's no surprise to me that finding the right audience is a very key challenge that a lot of lenders are facing. So especially I think in this market. So what this sort of complex chart is really trying to express is that in our analysis of individuals and their propensity to open a HELOC trade and looking at characteristics of consumers, we actually found that generationally younger consumers are generally have a higher rate of utilization of their HELOC credit lines compared to older generations. And so you're looking at roughly anywhere from 81% to 100% of their limits. Sometimes they'll even use it beyond their limit. And I think the key takeaway here is that this is, generationally speaking, we've have a tendency to look at the average HELOC consumer as an older consumer. And I think in the point that I was sort of highlighting earlier in the conversation is we're seeing a larger available and tappable market down market with the younger borrowers. And it's not just that they are targetable, it's that actually once they're targeted, they have a general tendency to actually utilize their HELOCs more often. And so I think it's a very important and interesting takeaway that I think lenders should think about target demographics in addition to just their typical buy box characteristics for consumers, right? Looking at FICO, looking at available equity, DTI. And so the typical credit characteristics in available equity is important. But I think it's important to look beyond those characteristics too, because that's where you can identify consumers that would have a higher probability of converting and then also leveraging the available credit. So we also found in this study that those who opened their HELOCs most recently, that sounds kind of obvious, is that in the last 4 years, they had a much higher utilization rate than older trade lines, credit lines. So I think that might be indicative of just a broader need for more credit, right? Rising cost of living, high inflationary climate, tapping into cheaper forms of credit compared to, say, credit card or personal loans. And so there is a need. I think the data is showing that there is a desire for this type of credit, but I think it's going after the consumers that I think would be the most open to or amenable to a HELOC. So I think that's one of the clear takeaways from this slide. So I think we touched on the fact that education is a huge problem. Targeting the right consumers is a huge problem. Another challenge, and really I'll share kind of a personal anecdote, is that there is this perception issue that HELOCs are not fast. They are like a traditional mortgage product. It is just faster and easier to get a new credit card, to do a balance transfer, to get a personal loan, to borrow from your aunt. So there is this issue around, and this perception, and I would say that this is partially a reality, right? So I was helping my father get a HELOC for some home renovation many weeks ago, and when I had helped them apply, we didn't hear back for 2 weeks, and we got a call from the loan processor 2 weeks later saying, "Hey, he's been approved. Everything's looking great. We'll let you know when it funds and if we need anything else." And so, I mean, it's astounding to me that we live in this era in which I know when my UPS driver is about to deliver my package, and yet I still don't know what's happening with my loan. And so, creating a more transparent experience is an extremely important one. It sounds like a very obvious thing to do, but it still is not. It's. I mean, I experienced it personally, so I can't imagine, what percentage of the market still is not prioritizing the need for speed and transparency and efficiency, and then leveraging technology in a way that sort of incorporates the borrower into the experience. So I think that's a really sort of important and key takeaway, and not just identifying the market, but also addressing the market's needs, right? Especially as you reach down market. So I think, I'm going to hand it over to Devin. I think he's going to touch on some of the challenges when it comes to third-party fraud, in this space, and some of the options and opportunities available to address it.
Absolutely. And there's two sides of this coin, right? There's the speed to offer, and this digitization opens up so much opportunity for one, people, but two, your bottom line. But again, makes this an exceptionally high value target to fraudsters. And so how do we balance this equation? And how do we respond essentially in this arms race against AI to stay ahead of it? And the most effective response we've found is to really remove the digital veil. So we have implemented a technology that incorporates behavioral analytics that allows us to essentially see the digital body language of the person across from us. And I want you to really personify this and think about it in person as I explain this. Imagine if somebody walked into a bank and I asked to fill out a HELOC, and the clerk asked me this, hands me the form. I grab the form and I stare at it for 10 seconds, just simple information. And then I look in my pocket, and then I come back to the form and start to write down a social security number. And then I look back and I start to write down a first name. Even if all that information is correct, you, based on my body language, can know that I am not who I say I am. I could have everything right, but based on my body language alone, you know that I am who I say I am. Just as you see me on camera now, you can tell that probably love my job. I do. I think this is cool stuff in the world, but also you can tell so much about me. I'm not reading off a script and things like that. And so this technology that we use, this behavioral analytics, when it removes that digital veil and allows us to see how a user fills in the information, allows us to do two very important things. One, we'll be able to pick up that fraudster and see them before they've clicked submit, that they don't know that information, that it's stolen, even if it's right, and we can stop them and keep them at bay without impacting your good customers, right? We don't want to create so many controls that nobody can get inside of our financial castle. And so what we can look at now is, regardless of where you're from or your digital literacy or, the language you speak, if you know something, you truly know it, right? If you ask someone their first name, they'll know it from deep memory. And so when we look at how genuine users behave, we can look at these interactions and say, hey, this individual may be the first time we've seen them, and they may be coming from an area that we don't normally serve. And there are things that look risky to us, but when we remove that digital veil and we look at how they enter that information and the picture they paint with their digital body language, we can say that indeed is a good customer. And the example I'll use here, I don't know how often you experience it, but I was born in rural Idaho on a potato farm, and that's not a joke. And my dad to this day still uses a flip phone only because mom makes him use it so we can reach him. He's never used a computer, never used a smartphone. And imagine if he came to your website and wanted to open up a HELOC. That individual would type poorly, and there's a lot about the device and where it's coming from that may look risky, but we can still say, hey, Jeff Smith is familiar with the data he's entering, and we want to ensure that we don't reject him, we foster trust, and we let him through. And so again, the how users behave is a critical response to protect this high value space from fraud, but also continue to financially enable the citizens of the US who want HELOCs. And as we move to the next slide on this, I think this is quite powerful and worth noting is fraudsters, as I've mentioned, have operated behind this veil since we went online. And when I started a decade ago, we used device fingerprints to stop them, and they've really figured out how to get around that. And here you see two examples of what happens when you remove that veil, and we can see the behavior of our crowd and our population. You see two different examples of customers who turn this visibility on. They see this high risk population that's at their door that they don't even know is there because the information is right. And these fraudsters are very, very sophisticated in addition to using AI. And as soon as those organizations begin decisioning, it is apparent immediately to the fraudsters that that veil they've hidden behind is now gone. And as they stand outside the bank or as they walk into the HELOC, people can now see them and they can see that they are not familiar with that information. And it acts as an active deterrent, even in the most high risk vectors that you could possibly operate in, like HELOC. So I think that is to one more poll question, I believe.
All right, give me one moment to pull this poll question up for everyone. But in this question, we're going to ask you, where do you see the biggest opportunity for AI and analytics to impact HELOC marketing? Give me one moment. So where do you guys expect the audience to see these results?
I'm really looking forward to see what the audience's pain point is and the opportunity is, right? Whether it's in the initial campaign design for improved credit worthiness and targeting, right? For the credit-worthy consumers, which I think we saw in the previous poll question was high on mind for a lot of attendees. Then what's the best channel, right? How do you optimize your outreach channel, such as email, SMS, direct mail, or digital advertising? Do you want a lot more focus? Do you see a lot more focus happening in that space? The third being analyzing and refining your campaign performance, right? It's the post-campaign, how many people actually ended up clicking the links or going through a process or just ignoring the whole email itself, right? What does my campaign, my offer look like for the consumer? Am I doing it the right way? Or is it like the long-term consumer incubation, right? I mean, they may not be ready right now, but do I want to spend more of my analytics and AI resources to actually ongoing incubation of these consumers?
So let us know where you see that greatest opportunity for AI and analytics to impact HELOC marketing. We see those results coming in. So continue to choose. I'll give everyone a moment longer, and then we will share these results.
As folks vote, I strongly agree with Upavon. AI, you can tell I'm an AI junkie just because I live on the front in it. But what I look at it, and I'm curious what the folks here have to say, is it's like a rising tide that raises all ships, right? The question is where do you first apply it to increase those efficiencies? And I am thinking that it'll probably be question D that most choose, but who knows, right? It depends on the nature of the organization, and it's really just where you direct it first.
All right, I'm going to end the poll now and share the results. All right.
Oh, it's an order. That's great.
Okay, now I'm going to turn things back over to y'all.
I mean, what's your take on that?
Yeah, I mean, again, not surprising, and I think the next couple of slides is going to speak to how lenders can leverage both machine learning and harness the power of data, both attributes and models, to sort of better identify consumers that have a propensity to convert, and being more intentional about selecting and choosing the right data to maximize the benefit from their marketing spend, right? So I often hear from a lot of clients recently, especially, is that they would much rather pay more for a lead if that reduces the cost of the acquisition of the business, of the consumer, as opposed to vice versa. And so I think historically, lenders have thrown resources at it. It's sort of been a quantity issue. So let's buy as many leads as we can, and then at some point, some of them will convert, and it's a numbers game. But I think, especially in this market, I think there needs to be a sort of an adaptation to the shift in borrower propensity and just the fiscal climate. So I think what's interesting, right, is going back to the earlier conversation around choosing data that's more than just your traditional buy box indicators of creditworthiness. So it's looking at the behavioral aspects of a consumer that might be indicative of greater propensity to convert. So in some of our analysis from our data science teams recently, we found that consumers that are revolvers have a greater propensity and a greater response rate to targeted marketing than transactors. So revolvers just means consumers that typically carry a balance month over month. It does not necessarily mean subprime consumers. There are plenty of super prime and prime consumers that carry a balance month over month. And transactors refers to consumers that generally have a very ad hoc credit need. They get the loan, they use it for what it's needed for, and then they pay it off very, very quickly. But what's interesting is the individuals that behaviorally have a tendency to carry a balance, and again, these can be consumers that are that are super prime or prime, have a greater tendency to respond to a HELOC targeted offer and have a greater response, or will actually activate a HELOC. So they'll actually utilize the HELOC more often. It's a very, very interesting insight. I think the key takeaway from this, right, is that lenders should use more data to identify these types of consumers, right? So using more and more data to identify the behaviors in which would be indicative of a propensity to convert, as opposed to just finding consumers that are qualified, right, and within my buy box. So it's doing that. That's important, right? You want to target consumers that are qualified, but you want to also find consumers that have a greater propensity to convert too. So I think it's being more intentional about who you target and how you target them. Next slide. So I think we've talked about that there's a strong need to do this, but like how do you go about doing it, right? So I would say there's three major ways, right? Number one, there are many vendors in the market now that can deploy advanced machine learning algorithms models that can help identify consumers that are in the market, right? And that means using highly predictive data to identify consumers that would have a greater propensity to convert. So it's leveraging not just predictive modeling, but it's also leveraging in various input data and behavioral data and demographic data and various other data inputs. And everyone's going to sort of talk about some of what those other data inputs might be. And then deploying various models, custom models. We have our own. Experian has its own versions of these models They can help identify consumers that are going to be in the market or maybe in the market, but also consumers that would have the greatest likelihood to convert. And we're looking at these things from a propensity, from a statistical modeling perspective, and not just actual sort of physical consumer behavior, if that makes sense, like buying a lead from a lead farm, right, or from a marketplace. So using actual advanced data science to statistically predict which consumers might be in the market. The next thing is and again, there's an obvious one, but it's a very important one, is to maximize conversion, you have to optimize the messaging. It's extremely important. We talked about how more and more consumers that are down market are amenable to things like a HELOC. 30% of consumers that obtain a HELOC for home improvement are actually below the age of 43. So you want to target this messaging to the appropriate demographic group. And there are many ways to do that. The likes of Experian, the credit bureaus, we have some of this data to help do that. And then, lastly, you don't want to overlook the non-responders, right? So there are tools out there that can allow you to understand why you lost the business, right? So it's not just, it's yes, you found the consumer that's fitting your buy box. They happen to be in the market, but why did you lose the opportunity? Was your pricing robust? Who are the competitors in your space? Understanding that. What were some of the key features of your messaging? Did you message it correctly? All of those things are very, very important in determining how successful your marketing campaign is, right? Especially as you reach down market. And I'll turn it over to Upaman, who's going to kind of talk about the importance of data in the inputs in various models, and just the importance of data in general, the different flavors and types of data, and just various tools that are available right now in the market to address this problem.
Thanks, Ivan. Let's go to the next slide. Yeah. So as Ivan mentioned, right, I think with all of the conversation that's just ongoing around AI, right, the biggest component that sits behind an effective AI tool or a machine learning, I mean, a traditional AI or a generative AI, is data. That's the foundational piece. The more multi-connected, diverse data that you have within your ecosystem, the easier your job becomes, right? And how far back does that data go, right? What's the depth of this data? Because for any predictive machine learning model, whether it's the in the market model for HELOC, for mortgage, for personal loan, any product, right? Just understanding the behavior of consumer, both financial behavior as well as non-regulated shopping behavior, both are key. And one of the big key elements is making sure that they sit within their own separate areas, so that in terms of the regulations and all that, there is no intermingling. But at the same time, how do you layer it one after the other, right? How do you define your baseline population and then do a credit check, a box run and whatnot? Or is there a better way at the end of the funnel to define the offer type based on different shopping habits and the cost of origination and things of that nature, right? So the big thing is, I think the more data that you have already pre-connected, and the behavior, and that is more the broader that data is and deeper that data is, your models are actually going to perform in different macroeconomic cycles. They would stay robust, and that's the way how you differentiate between 10 or 20 different companies that are selling different predictive models, right, and are marketing different performances, but how does it perform in different environments, right? So, so the and the more data that you have in house or are getting from somebody who has it in house, the less time you are spending in making it connected and cleaning, and then going out after with your modeling exercise, right? So the granular the trend, the more deeper your data is, the better your models are always going to be. If you go to the next slide, I think the other aspect that, and Experian being a data company, right? We can talk data all day long, right, Ivan? But the other key component that I would point to is the trended behavior of a consumer, right? Is a consumer going down in their financial behavior? They were excellent and now they are good at the current point, or they have been improving their financial behavior and their financial standing. They were fair and now they are good. So both of those at this point may look the same, but what is the trajectory is what defines how what their credit needs are, right? And how they are going to respond to a particular offer and whatnot. One example I'll give you is in one of our models, we found that credit card balance, if that grew by more than $4,500 in the previous 24 months, those consumers were about 5 to 8 times more likely to originate a HELOC compared to a baseline model, even in the even the high in the market model consumer. So trended behavior, which is around their balances, their utilization, their payment pattern shifts, is another key element to look at when you are leveraging AI and machine learning for prospecting. So I'll close it out. I know we only have 5 minutes left, but I want to get like one key takeaway from. I would love key takeaway from both Ivan and Devin as to what the audience should walk away with from this webinar. So Ivan, you wanna go first? And
sure, yeah. I think a key takeaway from my end is data matters, but a comprehensive look at data matters. So it's not just, we have to now go beyond the traditional markers of credit success. We want to look beyond those typical buy box indicators. We want to look into the behavioral aspects of the consumer. We want to be more intentional, proactive, and strategic on how we can target consumers, because that's unfortunately what is needed now in this market to be successful. In such a complex, competitive environment, in such a volatile environment, it is very important to look into how data can work for you and can help identify consumers that would show the greatest likelihood of converting. I think if you're going to spend the money on marketing, do it more intentionally and correctly, as opposed to just throwing money at the problem and buying leads as many as you can. Yeah.
Devin?
And I'd agree strongly with both Bhavan and Ivan on this. We talk about data so much, right? And you can collect all the data in the world, but what does that matter? It's like if you knew every word in the English language, it doesn't make you a poet. It's how you wield those words, or it's how you use this data. And that's what you want to do internally and externally. When you think about the data you have or the data you want, truly, how does one use it? And then the only other thing I'll say, just because it is so prevalent and is happening now, we're in the swing of this AI revolution. And as I mentioned last week, we saw what we thought was the first known, as far as we could tell, AI agent attack. And that acceleration is only going to continue. So as you think externally at the fraudsters, also look internally as how you could use that to augment all your processes and your defenses and hopefully make your life a little easier. So that's my 2 cents.
All right. I want to try to get a couple questions in. So the first one that I wanted to go back to is talking about the effective ways to address some of those misconceptions, like fear of debt or complexity, especially among older or first-time HELOC users.
I think as Ivan had mentioned before, right? It's reducing the friction, right? The more friction we can reduce from the whole process, the easier it becomes. I mean, a lot of times I think we give less credit to even like the older generation that's now that is trying to leverage a new product. People learn really quick. I mean, I see my dad doing things which I would have never expected him to at this age, but it's just the whole mindset of consumer having the knowledge of what is going on in the background makes it so much easier for them to, number one, ask the right questions, right? Number two, then understand the product itself and leverage it the right way, which is the ultimate driver of an ROI for a lender, right? So that's my take on it.
Yeah, I mean, I would agree. And I know we only have 2 minutes left, so I wanted to make sure we left enough time for some of the other questions. But short answer, yes, totally agree.
The next question I want to jump into is, how do you expect the HELOC market to evolve? Will debt consolidation continue to be the key use case?
I think so. I mean, debt consolidation has always been the biggest driver. But I think I was reading a recent research that came out of Harvard is home renovation is going to continue to grow, especially because a lot of people are now, I mean, by choice or by need, right? They are staying for longer in their homes, and they definitely want to leverage this equity to kind of bring the house to the best form and do some renovations, expand it if the family is growing and things like that. So that's another reason that HELOC is going to continue to grow. The last one being one-time expenses. There is a lot of that happening.
Yeah, and I'll quickly add, because I know we're up against time, there is the fintechs in the space are creating very innovative products around HELOCs, largely because of the existence of tappable equity. So there's home equity based credit cards now. There's faster, more efficient like HELOC applications and approval. It's interesting. I'm seeing a lot of the credit card companies are shifting into the HELOC space that traditionally wouldn't have. And so I think that there's a shift in wanting to take advantage of the rising available equity and the increase in home prices in the last 5 to 6 years. And so I think that it is a little bit of a feeding frenzy, but there's a lot of innovation that's happening around HELOCs in general. And I think there's tremendous opportunity for sure, I think, in the space.
Almost making it feel like a credit card, right?
Yeah.
Yeah.
Well, unfortunately, we are up against time. To our audience, I know that there are a couple of questions in the Q&A. HousingWire will be turning over all of the Q&A to the Experian team, and they will be able to answer your question afterwards. So we will make sure that you get your answers. But unfortunately, that wraps today's conversation, the $29 trillion opportunity, smarter strategies for HELOC growth. I want to thank our speakers, Upavan, Ivan, and Devin, for sharing their insights, and for everyone who joined us live. If we didn't get to your question, once again, we will make sure that the Experian team has all of the information to follow up with you afterwards. This webinar was recorded and will be sent to everyone who registered early next week. Thank you again for joining us, and we hope to see you all again soon.